Daniel is 41 years old. He earns $94,000 a year. He has a retirement account with $63,000 in it. He owns a home with roughly $80,000 in equity. On paper, he looks fine. He looks like someone who is handling it. He is not handling it. By the time Daniel retires at 65, assuming he continues exactly as he is right now, same savings rate, same spending patterns, same financial habits, he will have approximately $312,000 in retirement savings. That sounds like a lot, until you understand that $312,000, drawn down at a safe withdrawal rate, produces about $12,500 per year in retirement income. Combined with Social Security, Daniel will have somewhere between $28,000 and $32,000 annually to live on in retirement. He currently spends $67,000 a year. He has no idea any of this is true, and he has exactly 5 years, before the math becomes effectively irreversible. The financial cliff at 40 is real, documented, and almost universally misunderstood. Not because people don't know it exists, but because it doesn't look like a cliff from where they're standing. It looks like a plateau. It looks like things are fine. The danger of 40 isn't that everything is obviously wrong. The danger is that everything looks just stable enough that most people don't examine it closely enough to see what the numbers are actually saying about the next 25 years. Today we're going to examine it closely. We're going to look at what makes the 5 years between 40 and 45 the most financially consequential half-decade of most people's lives. What the math says about what happens if you use those years versus what happens if you don't, and exactly what someone standing at this cliff edge right now can do about it before the window closes. Let's start with why the cliff exists at all. At 40, 3 financial forces converge in a way that doesn't happen at any other point in a working life. The first force is peak earning proximity. For most professionals, income reaches its career maximum somewhere between 42 and 52. The raises that came reliably in your 30s slow down or stop entirely after this window. This means the 5 years between 40 and 45 represent your last reliable opportunity for significant income growth before the ceiling arrives. Every year you delay maximizing your savings rate during this window is a year you'll likely never recover, because the income to fund the catch-up may not be there later. The second force is the compounding multiplier collapse. A dollar invested at 40 has 25 years to compound before a traditional retirement age of 65. At historical average market returns of 7 to 8%, that dollar becomes approximately $5.40. A dollar invested at 45 has only 20 years to compound and becomes approximately $3.80. A dollar invested at 50 has 15 years and becomes approximately $2.70. The drop in multiplier between 40 and 45, 5 years, is larger than the drop between 45 and 55, 10 years. The math is not linear. The losses accelerate precisely during the window. Most people are still telling themselves they'll get serious about this later. The third force is fixed cost crystallization. By 40, most people's major financial commitments have locked into place in a way that becomes increasingly difficult to reverse. The mortgage that felt like a stretch at 38 now requires both incomes to service comfortably. The private school tuition that started at 1 child has expanded to 2. The car payments that each felt individually reasonable now represent a combined $750 per month in permanent monthly obligations. These aren't bad decisions in isolation. They're fixed costs that have crystallized around an income level. Creating a structure where significant savings rate increases require genuinely painful lifestyle changes, and the psychological resistance to those changes grows stronger with every year they remain in place. These 3 forces together, peak earning proximity, compounding multiplier collapse, and fixed cost crystallization, create the cliff. Not a sudden drop, but a point of leverage so disproportionate that the 5 years on either side of 40 produce wildly different retirement outcomes from what looks like very similar financial behavior. Let's make Daniel's math concrete, because abstract financial principles are easy to defer and specific numbers aren't. Daniel currently saves approximately 6% of his $94,000 income, or about $5,600 per year. Mostly through a 401k with an employer match, he's been contributing just enough to capture. If he continues this pattern for the next 25 years, his retirement account grows to approximately $312,000 at 65, as we established at the opening. Now let's change one variable. Suppose Daniel, starting this year at 41, increases his savings rate to 20%. That's $18,800 per year. This is genuinely uncomfortable. It requires real changes to his current spending patterns. His mortgage stays, his car payments stay, but the annual vacation gets reduced. The dining out budget gets cut significantly. Several subscriptions disappear. The lifestyle feels tighter for a period of years. At 65, Daniel's retirement account with the 20% savings rate from age 41 forward contains approximately $1,140,000. The difference between 6% and 20% savings rate, applied over the same 24 years, is $828,000. That gap, almost $1 million, represents one decision made at 41 versus deferred until later. But here's the part that most retirement projections don't show you. Suppose Daniel defers that same decision by just 5 years. Instead of increasing to 20% at 41, he waits until 46, telling himself he'll get serious once the kids' activity costs settle down, once the mortgage refinances, once things feel more stable. At 46, he makes the identical change to 20%. Same discipline, same sacrifice. His retirement account at 65 contains approximately $830,000. The 5-year delay costs Daniel $310,000 in retirement wealth. $310,000, not for doing less, but for doing the exact same thing 5 years later. That's the cliff. That's what the math looks like from the inside of the window versus the outside of it. The lifestyle trap at 40 deserves its own examination, because it's the mechanism that keeps most people from acting during the window when action matters most. By 40, most people have built a lifestyle that feels proportional to their income, not extravagant, not obviously excessive. Just the natural accumulation of a decade of reasonable feeling upgrades. The home got bigger when the second child arrived. The cars got newer when both incomes grew. The vacations became a family tradition. The private school felt necessary after visiting the local alternative. Each decision was defensible. Together, they created a monthly expense structure that consumes the overwhelming majority of a $94,000 income, leaving almost nothing for saving beyond the minimum required to feel like you're technically participating. The insidious part of this trap isn't the spending itself, it's the normalization. By 40, this lifestyle doesn't feel like a choice anymore, it feels like the baseline. Reducing it doesn't feel like strategic sacrifice. It feels like going backward, like failure, like something has gone wrong. And that feeling, that psychological resistance to what the math requires, is what keeps most 40-year-olds frozen at the cliff edge during the exact 5 years when movement is most valuable. What does genuine movement look like? The research on households that successfully navigate this window shows a consistent pattern that has almost nothing to do with income level and almost everything to do with 3 specific decisions, made within 12 months of recognizing the problem. The first decision is the housing audit. For most 40-year-olds, housing is both the largest expense and the one with the most potential for meaningful change. Not necessarily selling and downsizing immediately, but honestly asking, is this home sized for our actual life or for the life we imagined having? For many households, the honest answer reveals a home with rooms that are rarely used. Carrying a mortgage payment that consumes a percentage of income that no longer makes mathematical sense, given what the next 25 years require. The households that make housing adjustments in their early 40s, whether downsizing, refinancing, or eliminating a second property, consistently show the largest retirement outcome improvements of any single decision in this window. The second decision is the savings rate acceleration. Not gradual, not incremental, not will increase it a little each year. The math of the compounding window requires an immediate, significant jump in savings rate, ideally to 15% minimum, with 20% as the target for anyone who recognizes they're behind. This feels impossible until you calculate what it actually requires in monthly spending terms, at which point it usually feels merely painful rather than genuinely impossible. The difference between impossible and painful matters enormously because painful decisions get made and impossible ones don't. The third decision is the fixed cost review. Every recurring monthly obligation in the household, every subscription, insurance policy, phone plan, car payment, club membership, and automatic renewal needs to be reviewed against a single question. Does this recurring cost serve our next 25 years, or does it serve the lifestyle we built in the last 10? Many households completing this review for the first time discover between $400 and $900 per month in recurring costs that are serving inertia rather than intention. Redirected to savings, $400 to $900 per month is $4,800 to $10,800 per year. Invested from age 41 forward, that's between $170,000 and $390,000 in additional retirement wealth at 65. Here's what nobody tells you about the 5 years between 40 and 45. They don't feel urgent. They feel like the middle. They feel like there's still time, because there still is, just barely enough that the urgency doesn't register the way it would if the cliff were clearly visible. The people who use this window successfully aren't people with more discipline or more income than Daniel. They're people who ran the math early enough to feel the urgency that the calendar alone doesn't provide. They saw the cliff before they reached the edge, and they made uncomfortable decisions while they still had time to make them matter. Daniel's story doesn't have to end at $312,000. But the version of it that ends somewhere else starts with a decision made this year, not next year, not once things settle down. The window is 5 years. The math doesn't negotiate. The only question is whether you're going to run the numbers before the window closes or after.